Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
It's February the 1st of 2018. We're almost at the midpoint of the Q4 earnings season as far as the large cap stocks are concerned, and there's a lot of good to report on as far as what's been taking place. And our research director, Shiraz Mian, is here to do just that, right?
Sure.
So earnings in general have been stronger than expected. Large percentage of companies have beaten earnings estimates. An equally large percentage have topped revenue expectations.
Right.
All good. I'm understanding that Q4 2017 should mark the 6th straight quarter of positive year-over-year earnings growth and the 7th quarter of positive revenue growth. Is that correct?
Almost correct. It's 6 quarters of positive earnings growth and 6 quarters of revenue growth. So some folks may count the 2nd quarter of 2016, which was almost close to the break-even point, the 0 point. But in our data, it's modestly in the negative. So for us, the earnings recession ended in the second half of 2016, and this is the 6th quarter, the Q4.
All right, I'm glad I clarified that then for our purposes. So recap the scorecard.
Sure.
Without getting into tech, we'll get into that in a little bit.
Okay, sounds good. So we have, as of today, which doesn't have the evening results in, but the morning sessions are all in. 228 S&P 500 companies have reported results. This is 45.6% of the index's total membership. But if you look at the market cap that has reported, so you are, when you said we are at the halfway mark, this is 54.1%
I see.
of the index's market cap. You look ahead, Terry, so you knew that already. 15.9% are beating EPS estimates. 9.1%, as folks can see on this table, are beating revenue estimates. A very high, 82% are beating EPS estimates, and 79.8% are beating revenue estimates. And just to put these results in a historical context, this slide proves what you described at the top, that companies are beating estimate at a ratio that's above what we have been seeing in the past. And that's what this chart shows. The left-hand side chart compares the growth rate we are seeing now, EPS, earnings, and revenue growth rate. And the right-hand side chart shows the proportion of positive surprises. And as you could see, on every front, whether it's growth rate or positive beats, we are totally off the charts, at least in this period, which goes back to 12 quarters.
Yeah.
So very, very strong showing.
And something that we always talk about during these time periods is margins. So I'm also understanding that margins are wider now this time around than for a usual Q4 reading?
That's correct. So about 50 basis points gains in margins that we are seeing in the reports that have come so far, and also when we combine the blended picture, the reports and the still to come, so we are about 50 basis points higher. Energy is obviously doing better. We are seeing better results from the material sector too. A lot of these companies have cut the expenses out of their operations, and the top line growth is just literally falling down to the bottom. So it's a combination of revenue growth and margin expansion, but you're correct. Margins are wider than we have typically been seeing in Q4s.
So are the sectors you mentioned among the biggest, the sectors with the biggest increases?
Yes, so it's broad-based. There's momentum all around. In fact, when I look at my data, there's only 2 sectors that'll have year-over-year declines. Discretionary only modestly in the negative, and then conglomerates, that's a GE problem. On balance, we have very strong growth in energy for understandable reasons. Technology, you asked me not to talk about it, but it's a very strong growth in technology too.
Let's get into that then. What is that technology picture looking like? Because this is a big week for those companies.
This is a big week for them. Yeah, we have on the technology front, if we look at this slide, we have about half of the technology results have already come out. And this week we had yesterday Facebook and Microsoft come out with results. Today we have Google, Amazon, and the big one, Apple, coming out with results. But 53% of the tech companies in the S&P 500 have reported results already. And the chart we are showing folks here shows how the results for the sector thus far compare with what we have been seeing from tech companies in the past. And as you could see, whether it's on the growth rate, very strong growth rate, 28.4% earnings growth, 8.7% revenue growth in Q4. This is better than we have seen from tech before in this 12-quarter period, and companies beating estimates the same way as we are seeing in the aggregate. We are seeing the same in tech too. So more than 90% of the companies are beating estimates, and I wouldn't be surprised if we see a similar performance from Google and Apple later this afternoon as well.
All right. What about sales expectations? Are more companies beating on that front?
It's an amazingly impressive showing that we are seeing on the revenues front. And this slide, we are showing the performance of the companies whose results have come out on the revenue front. On the left side is the growth rate, on the right side is the proportion of positive beats. As you could see, in a typical quarter, about half the companies would beat revenue estimates. And here, it's almost 80% of them are beating revenue estimates. Growth, it's about 9%. Year-over-year growth in revenue. The average for these companies is about 2%. These same companies in the previous quarter, in Q3, had 6.5%, and we were saying praises of the Q3 earnings season. So very strong revenue momentum.
You have another beautiful chart on revisions. What is that showing you?
Oh, that's very beautiful. Yeah, this isn't something we are used to seeing in the earnings season. Typically, when we get to this stage of the reporting season, then the expectations for the current period, which is the first quarter of 2018 in our case, so we started out at 9%, as folks can see in the chart, at the end of November. In a typical quarter, by this time, that growth rate would have dropped to a 6.5%, 7%. And that would be the norm. And as you could see, we are totally in the opposite direction. Estimates are going up in a very profound way, almost 14% earnings growth in the first quarter. A big part of that is what's happening with the tax cuts. Then the energy sector's oil price thing is benefiting too. Higher interest rates benefiting financials. So a whole bunch of positive things are driving the earnings momentum.
And as you alluded to, nothing normal about this particular earnings season.
Nothing normal. We track and look at earnings on a daily basis, but even I have been surprised as to how good as it turned out to be.
So bottom line, are earnings still driving the stock market higher?
At any point in time, Terry, there are so many influences on stocks and so many factors are driving stocks. But at the end of the day, it's interest rates and earnings. Interest rates have been helpful for a very long time to stocks. The earnings question and the earnings picture improved about 4 to 6 quarters back, as you mentioned earlier, and has really accelerated now. So it's a big support for the stock price, and I think that trend should continue.
All right. Well, we're going to keep tracking it with you here and bring you back in a couple of more times before this Q4 earnings season is over. In the meantime, if you would like to keep track in text form, written form, Shiraz puts out a couple of commentaries a week on Mondays, generally, earnings preview. Kind of gives you the lineup of what kind of earnings to expect for the week, which companies are going to be in the spotlight. And then near the end of the week, maybe Thursday, Friday-ish, he comes out with his written commentary on the earnings trends in Earnings Outlook, the written form. So those will keep you updated on latest trends, nuances that he spots, wants to make you aware of. In the meantime, with Shiraz, I'm Terry Ruffalo.